Welcome back. It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. We're back with Ryan Lewenza. He's portfolio manager at Turner Investments Raymond James, to talk about something Canadians are always focused on, and that's the value of our dollar. It has slumped this year. It's lost about half a cent or so since the beginning of the year. It's trading now at just above 73 cents U.S. This is largely a story of U.S. dollar strength. As we'll see in a moment, the greenback has gained against all of the major international currencies. There's the Canadian dollar. But you think the Canadian dollar is due to rally in a fairly significant way. Go ahead.
Yeah, so here a couple of key points is, let's stand back. The U.S. dollar, which we've got up here, has just been on a tear. It's up against the yen. The yen's down 10%. The British pound. All major global currencies are down. And it's because the Fed is pushing out when they were expected to cut. Right. So the beginning of the year, the Fed was expected to cut 6 times. I said that was just impossible. And now with the inflation remaining hotter, it's pushing that out. So when U.S. interest rates are higher than Japanese interest rates or Canadian rates, it floods, investors flood in. So that's why it's been happening. But when you look at our Canadian dollar, it's largely range bound. I put out a blog a couple of years ago saying it was range bound between low 70s and high 70s. And here's where we are, and we're at the low end of that range. So I do think the Bank of Canada is going to cut first. They could start cutting as early as June. And that may cause the Canadian dollar to fall a couple pennies. So as you noted, we're at 73. Maybe it bottoms out at 71, 72. But then I see it recovering later this year and into next year.
On what fundamentals?
Okay, great question. So then you got to look at what are the drivers of the Canadian dollar. Well, number one is commodity prices. You just noted the copper is almost hitting $5, and I have been bullish on commodities. And so there is a strong long-term correlation. Now that correlation, say with oil and Canadian dollars, is kind of fallen off a little bit. It's not as highly correlated as it used to be, but I think that correlation will come back. So if I'm bullish on commodities, I'm bullish on copper, I'm bullish on gold, that should help our Canadian dollar. And secondly, the Fed will ultimately start cutting rates again. And that gap, that interest rate differential will start to come back in. So I do think in the very short term, over the next month or two, if the Bank of Canada cuts, you'll probably see a little bit of a dip in the Canadian dollar. We would then use that strength in the U.S. dollar to sell some dollars. So we have, right now, we're very happy with about our 22% U.S. exposure to the U.S. dollar. And what we're contemplating doing is we get a little bit of dip, maybe that Bank of Canada cut, use that to sell some U.S. dollars. So maybe we go sell one of our U.S. investments, we convert that into Canadian dollars at a very high level, and we either use that to buy some Canadian assets, or we buy a hedged ETF. So long story short, the Canadian dollar has been range bound for the last couple of years. I think it will remain range bound. And it's really simple. When the Canadian dollar is low, you sell some US assets. When the Canadian dollar rallies back up to the high 70, you do the opposite.
And when I think if viewers know that ETFs are what you use on behalf of clients. So when you're selling US assets, you're selling US ETFs traded in US and denominated in US dollars, correct?
Exactly right. So you could, for example, the SPY, the Spiders. This is the largest ETF in the world. This is the S&P 500. So you've got that trading on a US exchange in US dollars. So you could sell that investment, convert it at 138, whatever that is, back into Canadian dollars, and now use that to buy whatever. We could buy maybe Canadian bonds, we could buy some Canadian dividend stocks we like, or you could buy a hedged version of the S&P. So there's, but the main trade here, and remember going back to my point earlier about maybe raising cash. So one idea we have is, well, maybe we sell that US ETF, convert at the very high US dollar, put that into the high interest savings, and then wait for the summer pullback. Wouldn't that be a great trade to basically take some money off of the table, convert at a high dollar, and maybe buy lower? That would be great if it all pans out.
How often do you use Canadian dollar hedged ETFs?
We use them all the time in our portfolios. And so there's that kind of, we have a US dollar exposure. It ranges from say 18 to 22, depending on how much US dollar exposure. And so we're always going to have some hedged ETFs. And it really It's how much US dollars that determines that split.
Right, and when you say we have US dollar exposure of X, you're not talking about your US equity exposure. You're talking about your equity exposure in US dollars.
Correct, absolutely right.
You have other US equity exposure hedged to Canadian dollars.
Perfect. So yeah, just to flush that out, so roughly 60% in equities. We have roughly 40% in international markets, and half of that 40 is in US dollars. And the reason you want some US dollar exposure is that when things go awry, when you have the big market decline, what happens? People flood into the Yankee dollar. And so that provides a natural hedge to portfolios during tough times. But now, with that Canadian dollar low and that US dollar high, maybe we take a little bit off. And by the way, if I'm right, it gets back to 78, 80 cents. Maybe you add back some US dollars.